All right, children, there's three tools that the Federal Reserve can use in order to affect the amount of money that's in the economy at any given time. The Fed uses these tools to influence aggregate demand, either to increase aggregate demand or decrease it. If the Fed wants aggregate demand to increase, then it needs to increase the money supply. If the Fed wants aggregate demand to decrease, then they decrease the money supply. The less money there is available, the less people like us are going to spend. All right, so the first tool of monetary policy that the Fed has in order to control the money supply is the reserve requirement ratio. We talked about this the other day. This is the percentage of money that's sitting in banks in people's demand deposit accounts that the Federal Reserve requires those commercial banks to hold on to by law. So in order to affect the money supply, the Fed will either lower the reserve requirement ratio, which allows banks to make out more loans and makes the money multiplier bigger. They would do that if they want to increase the money supply. If they want to decrease the money supply, well, then they're going to raise the reserve requirement ratio because that makes it where commercial banks have to hold on to more money and can't give out as many loans. It also makes the money multiplier smaller. That's one way that the Fed affects the money supply. Second way that the Fed can affect the money supply is the discount rate. The discount rate is the interest rate that the Federal Reserve charges commercial banks in order to borrow from it. So if Bank of America needs to borrow money from the Fed, they pay what's called the discount rate. It's an interest rate. So if Bank of America needs to borrow from the Federal Reserve, they would have to pay the discount rate. If the Fed wants money to be easier to get and increase the money supply, then they would just lower the discount rate. They'd charge banks less to borrow from them, and then those banks can turn around and charge us less to borrow from the bank. If they want to decrease the money supply, they would just raise the discount rate because then it'd be harder for commercial banks to make out loans. The third tool of the Federal Reserve is open market operations. This is the most important tool, and this is the tool that the Fed uses most often. Open market operations are either buying or selling government bonds. So remember earlier when we were talking about deficit spending, and when the government deficit spends, they have to take out a loan in the form of government bonds? Those bonds are the government's debt. The Fed can buy those from commercial banks in order to increase the money supply. So if the Fed wants to create more money and make it easier to get a loan or easier to create money, then what they'll do is they'll buy bonds. And you can remember that by saying, buy bonds, big money. If the Fed wants to make the money supply smaller, then what they would do is they would sell bonds. What they're doing there is they're selling a piece of paper to commercial banks and taking cash from those banks. Once they take that cash from those banks can no longer loan it out. That makes the money supply smaller. Those are the three tools of the Federal Reserve. All right, children, first we're going to talk about how the Federal Reserve fixes a recessionary gap. Now remember, this is when aggregate demand has fallen, we dip into a slowdown in growth, so we have our real GDP decreasing and our unemployment rate is getting high. So our problem here is a high unemployment rate. The solution from the Federal Reserve, what they're going to try to do is increase aggregate demand and get people like you and me to spend more money. The way they can do this is by increasing the money supply. If there's more money in the economy, we can take out loans easier, the banks can give out loans easier, and aggregate demand will increase if there's more money to spend. So when we go into a recession, everybody, that would be commercial banks, us, consumers, and businesses all look at the Federal Reserve and go,
money, please.
Oh, no, there's no money.
Oh, my bad. No problem.
Oh, okay.
That's fine. I'll just destroy this office.
Oh, hey!
Money, please. Money, please.
all right, so the way that we fix this, what we need to do, we got three tools again. We've got our reserve requirement ratio. The Federal Reserve can lower the reserve requirement ratio. That means that commercial banks that have to hold on to a percentage of demand deposits, the money in their checking accounts, is lower. That means they can loan out more money. Not only can they loan out more money, but the multiplier is also going to be bigger. The lower the reserve requirement ratio gets, the bigger the multiplier is, the more money getting loaned out, the more we're spending, aggregate demand and increase and shift to the right. Second, the other way to do this, the discount rate. The Federal Reserve charges other banks, commercial banks, to borrow from them, and when they do, those commercial banks pay the discount rate. So if the Federal Reserve lowers the discount rate, that means that they give out loans to commercial banks for a lower amount of money, and that means that those banks can in turn around and give us loans for a lower interest rate. Finally, the most important tool, open market operations. If the Fed needs people to spend more money, they need the money supply to increase, so they'll buy bonds. Remember, buy bonds, big money. If they buy bonds, they're taking pieces of paper away from commercial banks and handing them cash that those banks can then turn around and loan out. That leads to an increase in the creation of money, which will lead to more money being spent and aggregate demand shifting to the right. All right, now we're on the other side of the business cycle. Now we're in an inflationary gap. Spending is too high, unemployment's very low, but your inflation is increasing. That's our big problem. Inflation is increasing, and we don't want to get prices to spiral out of control and get too high. So the Fed would run what we call contractionary monetary policy. Remember, the policies are named after what you're trying to do. Contractionary monetary policy because we're trying to decrease aggregate demand and shift it to the left. So if we're going to run contractionary monetary policy, our goal is to decrease aggregate demand. We do that by decreasing the money supply. If there's less money available for people to use in the economy, then it's going to be harder for us to spend money. And so the Fed can do three different things again. First is increase the reserve requirement ratio. If they tell banks that they have to hold on to a higher percentage of people's checking accounts, then they can't make out as many loans as they could before, and your money multiplier gets smaller. That happens, money supply will decrease, aggregate demand will shift to the left. Next, they can also increase the discount rate. If the Fed doesn't want commercial banks to give out loans anymore, to give out less loans, they can just increase the discount rate, which will make it more expensive for commercial banks to borrow from the Fed. If commercial banks pay more when they borrow from the Fed, they're going to charge us more when we want to borrow from them. If we're not taking out loans and we're not buying as much stuff, aggregate demand will shift to the left. So money supply is going down, aggregate demand shifting to the left. Finally, open market operations. Again, the most important tool of the Federal Reserve. This is their most important tool. They go on the open market and they go to banks and they sell commercial banks government bonds. So they hand them a piece of paper that says I owe you and take from them cash that was sitting in their bank. Cash that could have been loaned out had the Fed not just taken that money in a transaction. So now the banks have less money available to loan out, and aggregate demand will decrease because the money supply is shrinking. There's less money there, so we can't spend as much. Those are the three tools of the Federal Reserve. Now let's get a little practice in.
We're in here talking about practice.
All right, so we're going to do a little practice real quick. This first one, we're going to say that right now we're looking at a question that says your unemployment rate is at 8%. If we have an 8% unemployment rate, that means that our unemployment rate is high. If the unemployment rate is high, we're going to be in a recessionary gap. High unemployment is going to be a recessionary gap. High prices and low unemployment is going to be an inflationary gap. So right here, we've got a recessionary gap. We need to fix this. And the question is asking, what open market operation will we use to fix this? With open market operations, you have two choices. Buy bonds or sell bonds. Buy bonds, big money. Sell bonds, small money. So what we need to do is buy bonds. Once we buy bonds, that's going to increase the money supply. Which will decrease the nominal interest rate. And lead to aggregate demand increasing and shifting to the right. You are going to end up with a higher price level. Inflation is going to increase. If you buy bonds, inflation increases. The more money the banks make, the more money that is created, the higher prices get. Each dollar becomes less valuable. All right, let's look at one more real quick. Now we're going to look at a problem that says that inflation is 9%. Well, if inflation is 9%, then we're going to be in an inflationary gap. Okay. Price level. So if inflation is at 9%, we're going to be in an inflationary gap. I need to do markers. So we're over here, an inflationary gap. what we would need to do here, price level 1, YF, Y1. In order to fix this, what we would want to do with the money supply is decrease it. So people are spending too much money, prices are getting too high. To fix an inflationary gap, we're going to want to decrease the money supply so that the prices come back down. So we're going to want to, with the discount rate, we would increase the discount rate. If the Fed charged banks more money or more interest to take out a loan from them, they're going to charge us more interest for us to take out a loan from the commercial banks. And then the reserve requirement ratio, you would want to increase. To get out of an inflationary gap, you would want to decrease the money supply to make each dollar worth more. So you'd want to increase the discount rate and increase the reserve requirement ratio so banks couldn't make out as many loans. Also, with open market operations, you would want to sell bonds, small money.